get started. So welcome everyone to the webinar for JobKeeper for not-for-profits and charity organisations. My name is Kylie Hanson. I'm a senior consultant at WACOSS, which for those of you from other jurisdictions is the WA Council of Social Service, and a board member of Linkwest, which is the peak body for neighbourhood centres, community resource centres and small community managed not-for-profits in WA. I want to first acknowledge the traditional owners of the land that I am joining you from today, the Whadjuk Noongar people. Again, for those from other jurisdictions, it's a great part of the southwest in WA is traditional lands held by the Whadjuk Noongar people. I want to pay respect to elders past and present, and also just to acknowledge the lands that all of you are joining us from on today. We're being really pleased at WACOSS and Linkwest to pull this together with the generosity of David Gilchrist very quickly. So about 220 registrations tells us that it's a really big need for the sector. We will probably just jump straight into it because we've got quite a lot that we want to get through today. So David is on the call, you can see him as well. He's going to go through about half of the hour that we have together in terms of content and sharing the principles and the key things and considerations to think about with JobKeeper. And then we will have about half of the webinar set aside for questions. We'd like to run that by you typing questions into the webinar chat, and I will monitor those. If you could just also make sure you just address the questions to everybody, that would be great, rather than private messaging David or I. It's just a bit easier to manage that way. We will be making a recording of this available for people to watch back. And also for those of you in other jurisdictions or even in WA as well, the ACOSS and COSS around Australia are running a couple of other webinars with David next week. And so if there's additional things or extra questions that come out of those, we'll just make sure that everyone's got all of the information, and it will be consistently on the WACOSS, Linkwest, and I think the UWA website as well. So I am going to now hand straight over to David. So thank you for joining us, and thank you, David, for making the time to be here.
Thank you very much for the opportunity. It's great to be able to speak to everybody on what I think is a really important topic. And particularly has been great to work with WACOSS to bring this together. But I also want to acknowledge my colleague at University of Western Australia Not-for-Profits Research Centre in Tom Emery, who's a research fellow that has done a lot of work with me to pull this together in quick time. I guess the other thing I'd just like to acknowledge in relation to this presentation is that I'm sure there will be a lot of specific questions, and I'll come to a notice that I have to give you in relation to advice shortly. But do feel that you're able to contact us on the contact details that are provided in the last slide. We're very happy to get questions, comments, and also you might find that there's answers or other materials that you think are important. Please feel free to distribute them to us and we'll try and get them out as well. What I'll do now is I'll share the screen so that you can see the slides. Now, I hope everyone can see the slides there. I'm looking at Kylie to see if she will nod to say that they've come up okay. So the slides, as I say, will be available, pardon me, via the recording that we've made. As I mentioned, I do need to make an important notice in terms of this particular presentation. And as you can see, obviously the presentation is really only intended to be general information. It certainly isn't financial advice, and we're certainly not making recommendations about how to act. When I get to the next slide, I'll talk about principles that I think are important. And really that's what I'm trying to get to, is trying to build capacity in the sector to understand some of the decision-making principles that might be relevant here, and to, I guess, help in the way of helping you to be able to act on those principles. It's really important for organisations to appreciate that what we say is not necessarily specific to your organisation, and you as participants need to determine how your organisation should proceed in the context of JobKeeper allowance and all of the other things that are happening in relation to the not-for-profit and charitable sector in this COVID response. So you need to, I think, consider obtaining advice, typically from a tax accountant or an accountant. Your auditor might be somebody, but an appropriate professional person that can help you through the decision-making process. I think the other thing that we all need to remember too is that the situation is also changing very rapidly. We're getting new announcements almost every half day that relate to some aspects of what we're talking about. And so it might be worth tuning in or looking at the recordings from next week's seminars as well, in the case that there might be some new or different information provided as things move. We've worked very hard to try and get up-to-date information, but you must check the information that we're providing to make sure that it is current when you come to make your decisions. I think the other thing that's really important for you to realise is that ministers and others are making a lot of declarations and a lot of announcements, which is fantastic, trying to respond to the particular problems that organisations have identified in some of these programs, including JobKeeper. But a lot of those aspects have not yet been legislated. So while they've been announced, and everyone's very happy that they've been announced, you cannot necessarily rely on those. And I've tried to note those as we go through the presentation so that you can see the ones that we're actually waiting still for legislation to go through. Now, legislation has gone through the Commonwealth Parliament and the state and territory parliaments very quickly on this, and there's no reason why that legislation won't flow through either. However, the Senate in the Commonwealth Parliament has set up a committee to review these measures, and the Senate needs to pass the measures in order for them to become law. So there could still be snags in the way this legislation is dealt with. What about an agenda for today? So as Kylie mentioned, I'm trying to say a lot in about 30 minutes, but really on reflection, it'll probably go through to about 40 minutes to give people an opportunity to provide their feedback on questions and comments in relation to what's being said, and perhaps to help us too to set up the next webinar to make sure we cover everything off. What I want to talk to though is the scheme itself. So what is the scheme? And I'm sure most people in the room would be aware of the general principles of the scheme, but I want to talk in some depth about some of the key issues. Then I want to talk about principles. And I mentioned in my earlier remarks that I think it's very important for organisations to establish a set of decision principles as they approach things like JobKeeper, so not just JobKeeper, but all of the myriad of programs that are being established now to help organisations get through this crisis. And so I'll talk to some principles around how to define things like income, grants, what government agencies are or aren't, and so on, to help you to document your decision-making process. I'll also talk to some risk considerations that you might have to think about, and I'll also respond to a few frequently asked questions that we've noticed that people can continue to ask us about. And then at the end of the day, as much time as we need, we've got a Q&A session to allow us to take it up to midday Australian Western Standard Time to complete the program. Okay, so the key points I think really important that I want to touch on before I get into the scheme itself. The first point is that this is a pump priming measure. In other words, while COVID, of course, is a health crisis, firstly, there is a significant economic crisis. And as we did in the GFC, and as Keynes and other economists have told us to do for many, many years now, as we hit an economic road bump, the government is stepping in to try and ensure, number one, that the economy continues to operate, and number two, that after the COVID crisis, the economy structure or economic structure is still there to be able to be used and to be able to be built on to get us back onto an economic growth track. Now, whether you agree with those things or not, I think the important thing is that schemes such as these schemes are relatively simple, and that they're developed so that the government can roll them out very quickly without minimal means testing or minimal application processes. And they don't want to have means tests or application processes to any great degree, because it does two things. One, it delays the opportunity for recovery, and it also means that there's an extra administrative cost and burden that goes with the actual application of the process. So different outcomes will definitely be felt by different organisations. One thing that has been raised over the last few days is the ethics of applying where you think your organisation might not need financial aid, or financial aid to the extent that it might be entitled to. It's important to remember, and of course organisations have to make that decision themselves about whether it's ethically or appropriate for them to apply. But at the end of the day, it's important to remember that this is a pump priming measure. The intention is to get money out through organisations to build sustainability across the whole economy. And of course, if you are able to gather resources as a result of this, you can set them aside in order to be able to future-proof your sustainability for your organisation going forward. There will definitely be organisations that don't survive the process, but at the end of the day, there's not an intention, this policy framework's not intended to prevent those people or organisations that are able to survive from surviving. So the other problem, I guess, is that we don't really know what's going to happen with the economy going forward, and therefore I think most organisations need to ensure they accrue as many resources as possible to help future-proof in the short, medium and long term. The other key points I wanted to raise is that there are risks and costs to participating organisations. Firstly, you need to pay staff out of prior to approval from government for the process. There are many unknowns, and I mentioned that already. We don't know a lot of things yet, and we will try and highlight those as we go through the presentation, but it's very likely there will be post facto investigations and audits. After the GFC, there are about 14 Commonwealth Government investigations into the pump priming processes that the Rudd government put in place, and there will be similar investigations in relation to this particular process, and we need to be aware of that and organise accordingly. You'll also need to cash flow the payment of the allowance, as it's a reimbursement scheme, not a payment upfront scheme, and also the best interests of organisations it is in the best interest rather of organisations to develop a set of principles demonstrating their decision-making process and making sure you're documenting your rationale. So I guess one of the first red flags I'd like to say to everybody is it's really important for you to make your decision about whether you participate or not and how you arrive at that decision is documented so that you can use that documentary evidence at a later point should you be audited by the ATO or some other government functionality. Okay. So the scheme itself, the basic criteria, and again, probably everyone's very well aware of this. If you're a not-for-profit, you have to have experienced a 30% fall or greater in turnover of your organisation. If you're an ACNC registered charity, that turnover fall only needs to be 15% or greater. But in both cases, the organisation has to employ eligible staff. And I'll come back to what eligible staff are. The other element that's really important is that when we talk about turnover, we're talking about the comparable GST income that you reported on your BAS statement for March or April 2019 with the same month in 2020. So in other words, we're comparing month to month to take into account things like seasonality. If you prepare a quarterly BAS statement, then we're looking at your projected income for the quarter beginning in April with the same period last year. Now, there are some alternative tests available for different types of organisations as well. We don't necessarily want to go through that here because they apply to very few organisations and probably perhaps even no organisations that are represented in this particular webinar, but we are happy to present some information on that, and we have got some links at the end of the presentation that will help you to get information there as well. The requirement, though, only has to be satisfied once. So in other words, while you have ongoing monthly reporting requirements to government about your payments and the staff that you're paying to, you don't have to qualify more than once, and we'll discuss that a little bit later. Just remembering too, the enrolment deadline for JobKeeper scheme has been extended now to the 31st of May, but payments really must commence in the first week of May because we need, or rather government needs, to see that money starting to go out. Therefore, your application is really important to be getting that in as soon as possible in order that you are approved if that's appropriate, and then that you can recover those funds. There's a few other entitlement issues that need to be thought about as well. Firstly and foremost, and I'm sure there's no universities present, but there may be schools present. The ACNC registered charities arrangements don't apply to schools or universities. And as mentioned before, turnover needs to fall at least 15% below the same period as the previous year. Importantly, charities can elect to exclude government revenue from the JobKeeper turnover test, and I'll talk about that a little bit later, particularly in terms of principles about determining what government agencies are and what government revenue might be, as well as grants. But you need also to be aware that this is not a legislated item yet, so this has still got to go through Parliament to be confirmed. Finally, donations can be included as part, if they are part of the normal operating income. In other words, if your organisation regularly receives donations as part of its operating budget, then you would include those donations as part of your income for the purposes of this test. Not-for-profits don't have it so good as charities in a sense, in that turnover must fall below 30% for the same period last year, but those same arrangements don't apply for ACNC registered charities. Religious institutions are also having some changes, hopefully legislated in their respect. So a religious institution, if it's an ACNC registered charity, for instance, and it employs people, employs staff, then that charity has the same arrangements around those staff as it does, as do all other charities. However, if the religious institution also makes payments in respect of religious practitioners who are not employees, those practitioners are covered. And that helps, obviously, in relation to priests and so on, to support those people. Please note, though, that that doesn't apply to students. So if the religious institution employs students or has students on their books, then that doesn't apply if they are religious practitioners. International aid organisations are only able to participate if they're endorsed under the Overseas Aid Gift Deductibility Scheme, or they are or for developed country relief. Now, probably if there's an overseas aid organisation in the audience, it's important very much for you to get specific advice in relation to how to pursue this. But please note, the religious institutions relief and the international aid organisations relief is still not legislated. So that still has to go through Parliament before it's put in place. I guess the second thing is to know, what does entitlement actually get to you? What do you get out of this? So employers are entitled, or who are eligible rather, for JobKeeper payment for all current employees, including those they might have rehired, who at 1 March 2020 are Australian citizens, can't be under 16 or 17 or younger if they're students, were full of part-time or were casual for more than 12 months, who agree to receive the allowance. And this is important. So people as employees need to sign a form to say that they agree to receive the allowance. And this is documented. Volunteers, of course, aren't eligible because they're not employees of the organisation. We'll talk about some of these things a little bit more deeply in a minute. What does it get you? JobKeeper payments are paid in arrears each month, and employers need to pay an eligible employee a minimum of $1,500 a fortnight before tax. So the $1,500 is remuneration to the employee in the traditional sense, and tax applies in relation to that $1,500. That, however, may require some employees to be topped up. And of course, employees who would normally be paid more than $1,500 a fortnight can't have their employee entitlements or remunerations reduced to that $1,500. The first payments to eligible employers will commence in the first week of May 2020, and JobKeeper payments can be made for the period beginning 30th of March. Payments will only be available from the date the employee was rehired or back paid in the case that there's a back pay. So in other words, 30th of March 2020 has obviously come and gone, but because of the COVID period and because we're trying to pump prime the economy, government is prepared to allow organisations to back pay those employees and then to claim that through this scheme should the organisation be entitled. There's a couple of other important considerations. The one in all-in principle. So organisations can't opt to apply for JobKeeper for specific employees or a group of specific employees. They have to apply on behalf of all employees, or rather in relation to their whole workforce. All eligible employees must be covered by the scheme. So some of the employees may not be eligible because of those restrictions that have previously been mentioned, or because they are employees that have multiple jobs, multiple employers, and they're actually working with other organisations, and those other organisations are claiming JobKeeper rather on their behalf. So obviously employees can only be able to be used to claim JobKeeper allowance by one employer. They can't claim by multiple employers. It's not possible to select and choose, and not all employees are entitled, as we've said before. In relation to traineeships, it's important though that JobKeeper payment for individual apprentices can't be made if there is a supporting apprentices or traineeship in place during the same period. Employers need to think about how they might choose to select a payment depending on the best options and best supports for their particular circumstances going forward. The other thing to be thinking about is the fact that continued payments may also need to be thought through. If employers do not continue to pay their employees for each period, they will cease to qualify for the JobKeeper payment. So employers need to continue to pay. And as I mentioned before, there is a cash flow risk there because that $1,500 is not paid by the government in advance, it is paid in arrears. The minimum $1,500 per fortnight per employee payment is to be paid for JobKeeper payment for each nominated employee per fortnight. This may mean that supplementing pay for some employees is required. In other words, people who are used to getting paid less than $1,500 a fortnight will need to get a supplement to bring their payment up to that amount. For the first two fortnights, rather, from the 30th of March to the 26th of April, that can be back paid, as I mentioned before, but it has to be paid by the employer by the 8th of May. In other words, that deadline is coming up very quickly for employers to make a decision as to whether they back pay their staff for that particular period. Importantly, annual leave and other leave entitlements are also a consideration here, as you can imagine. If you like, an employee would have normal working hours or normal levels of remuneration, and their annual leave and other entitlements accrue to those normal payments. Where there's a top-up, that top-up does not attract annual leave or other entitlements unless staff work more hours or work, so to speak, to earn that particular topped-up arrangement. So in other words, if they're earning more money because they're working more hours or they're acting in higher duties or performing some other work that entitles them to $1,500 or more per week, then that work attracts the annual leave and other entitlements, not simply the top-up payment, not the differential. It is important to realise, though, that this legislation is pending on this, particularly in relation to superannuation, which I'll talk about shortly. In relation to super, the rules, as I mentioned, are being introduced, so this is not legislated, but where an employee typically works or earns less than $1,500 a fortnight and is topped up, that top up doesn't attract superannuation, or is not intended to attract superannuation rather, as it's not worked for or earned income in that sense. So superannuation is only payable on the amount of earned income. As mentioned before, if the employee does increase the amount of hours that they work to earn that $1,500 or more, or changes their role within the organisation to be entitled to be paid more, then that work attracts superannuation. Now, this is currently at odds with the superannuation guarantee legislation, as many people would be aware, which basically requires that the money that is paid over to an employee attracts that superannuation. And so there has to be a legislative change to put this in place. If that legislative change doesn't occur, people may be at risk of having to pay that additional superannuation in relation to the top-up, and you need to think about that in terms of the risks associated with this particular program. Importantly, withholding taxes should occur as usual, so PAYG applies accordingly. And accrued annual and sick leave, the information is a little bit patchy on this, and there's still a lot of work to go to work out the exact arrangements in relation to those elements. But essentially, there are no changes to the regular contractual accrual of annual or sick leave for individual staff. In other words, again, if a staff member is topped up, it is expected that their annual leave and sick leave accrues according to the work that they would normally do and in accordance with the payment that they would normally get. Any top-up doesn't attract these emoluments. One of the other things, though, that needs to be thought through, and has certainly come up in questions around the sector, is whether or not, if staff are paid the $1,500 amount, do they actually have to turn up? And the fact is, we can't, or employers can't make people turn up to work for these amounts. These amounts are part of a stimulus package. But there will be reductions in emoluments and remunerative outcomes for staff if they don't work, particularly in relation to superannuation and leave entitlements and so on, as I've said before. I'll talk more about having staff work and what kind of options are available to employers in that respect. Employees, though, can be asked, but not forced, to take annual leave, and they can be asked to work on different times, at different days rather than at different times, if that fits in best with the organisation's working requirements under the COVID challenge. So in relation to that, performance of staff is a really important thing to be thinking about here. So I mentioned before, can staff be asked to come to work when they're paid the $1,500? People have certainly asked whether staff can be made to work more hours. In other words, to make up for the supplementary pay, to increase the supplementary pay. Now, there's two aspects to that, and I've already mentioned one, and that is that if people do work extra and earn that top up, then there are other emoluments like superannuation, annual leave, etc., that will be costs to the employer. But an employer cannot direct a staff member to do extra work, but they can request that. There is a form, there's always a form with government programs, of course, and a JobKeeper enabling direction can be given to by employers to employees to ask those employees to make up hours, or if it's reasonable and fits in the scope of the organisation, to perhaps do different jobs. The employee must be consulted at least 3 days before the JED is given, so the employee must have time to think about it. And employees must be paid their usual hourly rate or a higher rate if asked to do a job that attracts it. They can't be paid a lower rate in terms of changes to their employment arrangements. Additionally, an employee must also continue to be paid any applicable penalty rate or other allowance that applies to the work that they work or the way they work. Importantly, though, that JobKeeper enabling direction is really a request to employees, not an instruction to employees, and employees within reasonable bounds can reject that JobKeeper enabling direction. So I guess that's the scheme, but there are some principles that I mentioned before that I think are really important for people to start to get their minds around, because they're making decisions about whether or not to apply for this scheme and making decisions about whether or not their income has been reduced and so on accordingly. What I wanted to do in this section of the presentation, as I say, is to talk more about what the definitions of income are and so on, so that people can make decisions relative to their particular organisation and how these things might fit. So in terms of definition of income first, income is remunerative. That is, you receive income for providing a supply, but that supply has to be earned. So you have to have an entitlement for income. You have to have provided that supply. In other words, you might get income in advance, but still have to do work to be able to call that income in advance actual income. We call this unearned income, which is income received, but not income yet. The supply is yet to be provided. Your auditors and accountants can probably advise you in relation to this if this is an unusual discussion from your experiential point of view. Importantly, though, one of the other elements of income that is certainly really important to consider is the cash booster payments. And I confirm that these are non-taxable and exempt income streams. So you might wish to, with any booster payments you receive, allocate those directly to a reserve or an investment on your balance sheet rather than putting them through profit and loss as income. Certainly cash booster payments, so forgiveness of PAYG and other amounts that your organisation owes to the ATO, are not considered income for the purposes of JobKeeper allowance and shouldn't be used in that calculation. So the second nuance in all of this is around government income and whether or not government income is to be included in your assessment of income or whether it isn't to be included. So income received and earned from a government includes the Commonwealth, states, territories and local governments. And remembering this is a measure that is only available to ACNC registered charities. Whether or not an agency is a government agency is a often asked question, because there are some peculiarities around different jurisdictions around Australia. And in Western Australia, for instance, we have things like the Lotteries Commission, but at a national level, we also have the National Disability Insurance Agency or scheme. A government agency, in terms of principles, can be identified by looking at their establishment legislation, by looking at whether or not they're subject to public sector governance legislation, subject to ministerial direction, The Lotteries Commission, for instance, is a government agency because it's an agency of the Crown. It might have a specific clause removing tax obligations in its legislation, and the Auditor General might have an auditing role in relation to that organisation as well. So even if a government agency in a Commonwealth, state, territory or local government situation isn't necessarily immediately, obviously, a government agency, or you've never perceived it as such, use these tests to see whether or not it is actually a government agency. Where there's grey area, there's two sorts of grey area. One is that the agency is not immediately obviously a government agency, or that these tests might be inconclusive in your mind. The third element, though, occurs in schemes that adopt quasi-market arrangements to be able to allocate resources, such as the NDIS. And I think in the NDIS situation, the NDIS is a government agency, but the income arising from the NDIS is also a government income, because we need to look at things like who negotiates or sets the price, who do I invoice, who sets the administrative and financial structures, and who pays at the end of the day. Importantly, accounting principles still apply. So NDIS payments in advance, for instance, are still unearned by definition, and you need to be aware that those amounts are going to have to be applied against future services provided. This is a big trap for a lot of organisations, where some government agencies in good faith provide money in advance in order to build sustainability or solvency, retain solvency within organisations, but that income in advance has to be earned. So there is outgoing cash flow from that. The other element that is seeming to cause some discomfort around the sector relates to grant income. And essentially there are two types of grants that people need to be aware of. One's an income grant, and an income grant comes from government or any organisation in consideration of a supply to be made, or it relates to an amount received by an organisation as a sustainability payment. Now, these definitions are available in the Australian Accounting Standards, which I think are a really important touch point for accountants in the context of making decisions about whether or not income should apply. But that means that Lotteries West grants that are provided for sustainability purposes, even though Lotteries West is a government agency, is income for the purposes of this assessment. But because Lotteries West is a government agency, you can actually remove that, or rather take the option to not count government income in relation to this particular item. So in other words, when you're making your application, know that Lotteries West grants, or grants similar to that from other organisations that are provided purely as sustainability payments, are considered income. But if they come from government, then charities, ACNC registered charities, are able to remove those from their income list, if you like. Asset-related grants, on the other hand, are generally received and paid on to a third party and relate to amounts that are paid for assets. So how much you might get provided by a government agency or a lotteries agency in relation to purchasing a bus or a building or something of that nature. It's important to understand that with income grants, that profit and loss, or rather that amount of money goes through the profit and loss when the supply is provided, or in the case of sustainability payments, when the sustainability amount is provided. With asset grants, though, there's a different accounting for that, and we would expect to recognise that grant over the life of the asset. So if you received $1 million for a building today in your not-for-profit or not-for-profit or your charitable organisation, then you would look to recognise that grant over the period of the life of that asset as you consume the asset against depreciation, rather than putting $1 million into your profit and loss today. Obviously, there's a balance sheet impact, but there's a really important calculation there in relation to your applying for this particular grant program. Turnover, as I mentioned before, is applied according to the calculation for GST purposes. Importantly, it includes all taxable supplies, but not input tax supplies. So any income that comes from house rents or any of those kinds of input tax supplies is not considered here. The ACNC registered charities have those different rules for turnover, which I mentioned before. There are, as I also mentioned, some alternative decline in turnover tests available, and those links are provided at the end of the presentation. Okay, some risks for consideration that I think are really important. First and foremost, I mentioned before, I think it's critical that organisations pick up on the principles related to how you're making decisions and to be able to allocate your income and expenditure decisions and document those appropriately. It's important, I think, because in the aftermath of this process, there will be a investigation into organisations that have appeared not to have been reasonable in their assessments or who appear to owe the government money as a result of turning out not to be eligible. And certainly the ATO and other government agencies at the Commonwealth level have made note of this. If it's later determined that an organisation wasn't entitled to JobKeeper, you'll be required to repay that amount back to the Commonwealth Government. It's also important to recognise that the Fair Work Commission will arbitrate disputes in relation to JobKeeper enabling directions and other aspects of the JobKeeper arrangements. And anecdotally, I'm aware that the Fair Work Commission has already started to receive complaints, particularly complaints, it seems, in relation to people who are receiving top-up amounts but are working different hours or appear to be unequitably working more for their top-up amounts than some other of their colleagues in organisations. It'll be interesting to see, of course, how that gets on. Do document all decisions as I've suggested, but I think the other thing, particularly for accountants in the room, it's important for you, if you are going to change your accounting treatments in order to assess your eligibility for JobKeeper allowance, that you also continue to run with those accounting changes post-COVID, post the allowance. Because I think consistency is a really important part of the assessment about how you treat income and how that income might be modified or changed according to the accounting objectives that you might have. The more you change, the less credibility applies to the decision-making framework you're applying today. So you need to think about that going forward. Proof of income drop according to the rules needs to be made, as I've said before, and you need to be able to document any reasonable estimates if you need to estimate rather than actually using actual income or actual expenditure. Remembering that first quarter, if you actually undertake BAS appropriation, you lodge your BAS on a quarterly basis, then you need to be estimating what your income is going to be, and that's very difficult, of course, going forward. Any JobKeeper enabling directions must be in writing, and you need to, I think, keep a record of what the response was from the employee in relation to that JED as well. So there's some ongoing reporting requirements, so you don't have to go through your eligibility process again, but you do need to report on a monthly basis to the ATO, providing information as to the current and projected GST turnover that you have, and also reconfirming the eligibility of your business and your reported eligible employees. It's not a retest of eligibility, but rather a confirmation of eligibility. And obviously the ATO will also use this data to see how long this particular program is going to be extended for. You do need to maintain a list of your eligible employees on a month-by-month basis and advise of changes to your eligible employees on a monthly basis as well. Okay, so there's some frequently asked questions as well, and some of these may be obvious coming out of the presentation that we've just had. But I guess first and foremost, what if we no longer meet the requirements? Do we have to step out of the system? No, eligibility only needs to be proven once, but monthly income must still be reported. That information will be used to determine the length of the offering of this program, and remembering this is a pump priming program, so the government is keen to get as much money into the economy as possible. What happens if staff get paid the allowance via different organisations, and to what extent do employers need to inform themselves of their employees' other jobs? It's up to employees to nominate one primary employer, remembering two things: that when an employee fills in a form to confirm that they want to participate in the scheme, there is a box on the form that allows them to tick to say they're not claiming the scheme through any other employer. If an employee has multiple employers, and that employee is casual with most employers but permanent at one employer, then the permanent employer has to be the employer that pays the JobKeeper or through which that employee participates in the JobKeeper scheme. Do employees receiving the allowance have to go to work? Eligible employees must be employed, and payment is on fortnightly basis where they're re-engaged. Standing down after a JED can be given if work is not available, but the payment still needs to be made. So you recall the whole point of this payment is to be able to support employees who have had businesses closed down or who are unable to earn their normal income as a result of the impacts of COVID. And so the expectation of government is not that employees necessarily work, but rather that the payment goes out in order to support those employees and build the economy. What post-COVID activities are likely to be undertaken by the government? Well, I've said all along that it's very likely that the government will undertake investigations. Certainly the Commonwealth Parliament and state and territory parliaments will undertake investigations to look at how well the scheme worked and whether there were rorts or other things involved in the delivery of the scheme. The problem is, of course, we just don't know yet what form they'll take and what form any ATO audit program will take in terms of looking at organisations that it feels it should pay back any amounts of money. There's further resources also here, and I'm speaking very fast to give us time to have a Q&A. But please, once you get this recording, obviously avail yourself of these resources, but keep your ear to the ground in terms of announcements and other things that come up from time to time in clarifications that government might make. But remember, those announcements, those clarifications may be to the benefit of the sector, but they can't be acted on until they're actually legislated. So you need to sort of take into account whether or not they're rhetoric or whether they're actually legislated entitlements that you're able to pursue. As I mentioned, Tom and my contact details are there, so very happy to chat to anybody or to receive any feedback or comments. And I think I've done my 40 minutes. I'm really happy to take any questions or comments.
Great, thanks, David. So there have been about a gazillion questions, technically. Yep. So I'll try and get onto those. If David's comfortable though, everyone, we can look at these questions later and still get responses out to people, even if we don't manage to address it right now.
They'll help to inform subsequent webinars and any materials we can put out. Yeah.
Okay, so first of all, unearned income or income in advance is included in the BAS period. So do you exclude that in calculation and then need to do the same for the comparative period?
Absolutely. So a big problem here is that organisations will either provide or rather complete their BAS using cash basis or accrual basis. If you complete it using an accrual basis, then any unearned income shouldn't be in your BAS in any case because you haven't earned it yet and therefore it's not legitimate income. But typically organisations, particularly smaller organisations, use the cash basis. And that, I guess, is emphasised in my comments around changing your typical accounting arrangements just simply to meet entitlements. But your BAS income is intended to give you a starting point for determining what your income levels are. And so you make adjustments to that BAS income, taking into account any unearned income that might be sitting in the BAS statement and taking into account any government income that might be legitimately taken off your total income before you put in your eligibility claim or application.
Great, thanks, David. What if the organisation doesn't have the cash flow to pay staff the $1,500 JobKeeper?
This has been a big response by banks to make funds available for organisations to be able to do that. Those funds obviously are loan funds, but this is a real issue for the sector and one that's very difficult to get around. You do have to pay it up front. If you don't have the resources to pay it up front, then you have to go and get some form of funding to support you to do that. And if you get that kind of funding, then you have to pay it back to the banks and you have to pay interest. But the risk is that you might not be eligible in the government's mind at the end of the day. And therefore, of course, you are stuck having paid out those amounts.
Thanks, David. Sorry, I've got to go back up the 2 pages of questions. Do staff need to be Australian domiciled?
They do.
Great, easy one. We've talked a bit about the difference between full and part-time employees. Do non-taxable payments such as travel allowance get included in the gross when calculating the top-up amount?
We're still trying to do some work to try and confirm that. Essentially, I don't think it does, because the general rule is that allowances and supplements are still to be paid going forward if the employee is still working. So if the employee chooses not to work, then obviously that has an impact on allowances and supplements. But travel allowance specifically, we're still trying to work through, but the general rule is I think it would still apply.
Workers' comp income counting?
Workers' comp income, we're still working through as well. That's quite a minefield.
Great. There's a question, I'm not sure I understand it, so David, just say if it doesn't make sense. Are funders expecting funding received through JobKeeper relief to be applied to specific contracts and therefore acquitted back to funders?
No. So JobKeeper relief is paid by the Commonwealth to an employer, reimbursing that employer for $1,500 amounts or more, or are paid to individual staff. So in other words, it's not relevant to a funding contract or some other supply that your organisation is making for a government department or any other department. It's a reimbursement for what you should have already paid your staff.
Where does an employee who was on a fixed term contract, which say commenced at the beginning of March and had an end date of May, stand in terms of eligibility?
So that, what was the beginning date? I'm sorry.
So say they started commencing about March and had an end date of May 31st. Where do they stand with eligibility?
They've got to be employed for 12 months.
Great. What happens if an eligible employee currently working has not been stood down or rehired, declines the JobKeeper payment?
Nothing. So that person continues to work, is entitled to decline. So when you say declining the JobKeeper payment, I mean, this is an accounting process in many respects. And if I get paid $750 a fortnight as my normal remuneration, and I say I want to play, so to speak, then I get another $750 that my employer pays me. So I get paid for the work I'm doing, plus I get paid that top up. The government then pays $1,500 for each eligible employee. And so for want of a better term, the opportunity is inherent in the employer organisation to retain that $750 difference. But if an employee says, no, I don't want to do this, for whatever reason, they're entitled to not do that. And that means that they're not eligible employees in the fullest sense, because to be eligible, you have to meet all of those criteria, plus you have to say, yes, I want to be in that.
Great. There's some questions kind of around maternity leave. So I'll just pick up one of them. If a part-time employee has been on unpaid maternity leave for over 12 months, and not in receipt of any other income, are they eligible for the payment?
I think that this is a really difficult one, because it's essentially, if the requirements are you were full, part-time or casual for more than 12 months. I think the test is around whether a job is held open for you. When do you have to inform the employer that you're coming back to work or you're not coming back to work is also an issue, and whether or not that person is intending to continue work is an issue. But it's a very difficult one to be able to say categorically at this point, and we will continue to work on that one to try and get some more clarity around it.
Thanks, David. Long service leave, there's a couple of questions about that too. Is there any kind of general statements you might make about that? And can you confirm that the accrual is unaffected?
The accrual is unaffected by unearned income or the unearned top-up. So any earned income, or while you're on long service leave, you continue to earn your typical entitlements if you're permanent, part-time or full-time generally. But the rule is in all of this that the employment arrangements stay in place and continue forward. It's just the only difference is the top up. If someone's paid less than $1,500 a fortnight traditionally, then the balance that they're paid to top them up to $1,500 doesn't attract any entitlements unless that person works for that balance. In other words, they do extra work or perform extra hours or whatever it happens to be for their employer. And then those entitlements accrue. But up until that top up, or if you're paid more than $1,500 a fortnight, then the normal entitlements continue to apply. There's no difference.
some are putting questions into the Q&A and the chat. If you could not do that, that'd be great. Having the questions just in the chat is really useful because then we've got the record for it afterwards. David, a couple of questions around NDIS, and you mentioned that NDIS is a bit of a grey area. What is your recommendation?
I'm not able to recommend anything to anyone at this stage of the game. But what I would say is the NDIA, the National Disability Insurance Agency, is an agency of government. I think it meets a number of the tests that I suggested are important there. I think the final group of tests, though, also apply, and that is, so the question mark comes as to whether it's an agency or not, a government agency or not. I think it clearly is a government agency. But I think the second element is, well, you're providing services to an individual, and there's a lot of talk about choice and control and all of those things that are substantive issues around things like NDIS, but also care in aged care, for instance, where we use quasi-market economics to provide money. In other words, we try and institute a market economic result or a outcome. At the end of the day, the NDIS, I think people need to take into consideration, yes, you do provide a service for somebody. Yes, there is an opportunity for that person, that individual participant, to be able to determine what, when, how, why those services are provided. So in other words, they do get input into that process, as we all know, and that's fantastic. But at the end of the day, in my view, the calculus still remains that the NDIS is a government agency. The NDIS sets the price. The NDIS sets the quantity effectively through the planning process. The NDIS are the people that you invoice, and the NDIS are the people that pay. So I think organisations, I'm not able to make a recommendation, but organisations need to step through their government sources and make those determinations and document their opinion in relation to that. And there's not much more you can do, but I think those kinds of tests are fairly straightforward, and I think organisations are fairly much on solid ground, providing they document that sufficiently.
Thanks, David. There's a few questions around that 12-month length of employment rule. So is that applicable to casual, full-time, part-time employees? Or
yes. Yes. So they're full-time, part-time or casual for more than 12 months.
Great.
So I guess one of the things to remember, just getting back to principles, is this is a JobKeeper allowance. The idea is to pump prime the economy, but to keep the essential economic structure in place. And so what the government ultimately doesn't want is people not being employed, so they no longer become engaged in the employment market. And therefore the upshot at the end of all of this, the economy can't get back into gear, or business can't get back into gear, because people are no longer participating as employees.
There's a couple emphasising the ATO website mentions are only for casual employees, but applies to all, right? Is that? Yep. Yeah. Does the revenue shortfall comparison need to be in line with BAS reporting? So if we're using monthly and we're using March or April, and if quarterly, do we need to use the quarter April to June estimated turnover?
Say that again, I'm sorry, that was a...
So does the revenue shortfall comparison need to be in line with BAS reporting, i.e. if it's monthly, we use March or April, and if it's quarterly, do we need to use the quarter April to June estimated turnover?
Okay, so you need to use the estimated turnover, because what the government's trying to get you to do is to assess what the income impact of COVID is to your organisation. And of course, you won't, in that first quarter for this current calendar year, you won't have that impact reflected.
Okay, there's a couple of people still in the chat, David, just sort of coming back to this 12-month thing. Maybe we can just go and confirm it, but if it's a permanent employee, they're sort of saying, are we sure that they don't have to be employed for 12 months?
Oh, I see what you're saying. I'm sorry, I've misunderstood what you're asking me. So you have to be a full-time or part-time employee, or you have to be a casual for 12 months. I'm sorry. No, I
didn't frame it very well. So for the employees that will I think we might have addressed this. The employees that accept JobKeeper will not be entitled to 9.5% for those $1,500 received per fortnight.
No, they're not entitled to the 9.5% on the top up, providing the legislation is passed to that effect. So at the moment, the legislation it provides for the 9.5% superannuation guarantee levy to be applied to the payment, to the remuneration you pay to an employee. And my understanding is that that definition extends to the top-up amount that's paid to the employee. The fact that it's a top-up to $1,500 and the employer doesn't get value for that, so to speak, doesn't matter. So obviously, government is trying to reduce the cost to the employers of the top-up arrangement. And so the intention is to pass legislation so the 9.5% doesn't apply to the top-up.
Are there any reasons why eligible employees wouldn't want the supplement? So is there anything we should be communicating to them to enable them to make that decision or understand any implications?
No, I must admit, I tried to think of a reason for why you wouldn't. You may have, you may feel uncomfortable not earning the money. You may feel, there might be that you're uncomfortable, or you have a principle that makes you feel that you don't want to receive that money, which of course is absolutely legitimate. But I can't think of a reason why people wouldn't receive that or be willing to participate.
And the superannuation, could that be a reason? Someone's just posted in the chat.
It could, yes, superannuation could be a reason if those employees are also being able to access their superannuation, or there might be some pension or part pension or other reasons that might go with that, with low paid staff, that would make a difference, because the $1,500 is taxable income in the hands of the employee if they receive a top up. So that's a good example of where that might be a consideration.
There's a couple of people, I think maybe this has been covered, but just want some clarification. So in terms of the differences between registered charity and not-for-profits and the considering of grants as income, there's a couple of people wanting confirmation around that. So can NFPs ignore grant income or only registered charities? Or not ignore, but you know what I mean, consider.
Yeah, anyone can. So commercial enterprises get government grants all the time. You get government grants for innovation, you get government grants for exporting supports, all sorts of things. So government grants apply across all organisations equally. ACNC just simply means that if you're ACNC registered, you've got the 15 shadow as well, and you can take grants off the list in terms of income for you. For a not-for-profit, you've got to include those grants, but the accounting for them is exactly the same across the organisations.
Just a clarification on the previous question in terms of super and JobKeeper. So if the employee earned $2,000 a fortnight prior to JobKeeper and is now on JobKeeper, they don't get super. That's not right? It's just the super on the 500. Because
really what the government's doing is providing the employer with the $1,500. The employer has an obligation to pay the employee at least $1,500. But there's sort of two different transactions in a sense, because if you're, say, the accountant working for the organisation and you're on $3,000 a fortnight, then you don't really have any, this doesn't impact you, other than that the organisation gets $1,500 allowance for you, so to speak.
Can an employee elect to salary sacrifice the top-up amounts?
That's a really good question. We'll follow that one up. I couldn't tell you that, I'm sorry.
No, it's all good. I think it's all emerging, David, and we appreciate your time and your furious answering to the still 2 pages of we've got. All right, I'll just do a couple more, everyone, but then as we've said, we'll deal with them offline. If you pay this and then deem not to qualify, is there a way to recruit from employees?
No. No.
Is there any, with the government funding side of things and the eligible employees, do they have to be related to certain kinds of business? So the funded or non-funded business kind of thing?
No, any business can apply. The differences relate to charitable organisations, I guess, in a sense, and whether organisations operate overseas. So a not-for-profit has to operate predominantly in Australia to be eligible, for instance. So there's a number of those kinds of nuances, but there's no, all employers are caught, or rather are able to assess their eligibility, except for government agencies.
There's some longer questions here, which we, again, will probably just address offline and make them a bit more general so they're relevant to other people. But I'll just do one more question. What happens if new employees are brought into the organisation due to natural staff movements, so resignation or maternity leave cover, etc.?
Yeah, so if they're full or part-time staff, then they can be, that can be applicable to them. If they're casual, as you can see, it's casual for more than 12 months. There are rules, though, around new organisations and startups and being able to assess eligibility in the context of those startups.
Okay. We might leave it there. So thank you everyone for being engaged and very engaged by the number of questions that we had. We'll follow up with David offline. We'll make the recording of the webinar available to you, and we'll get some of the questions back to you as well, answers to questions. So thanks, and thanks very much, David, again, for your generosity and all of your knowledge that you're sharing with us.
Thank you very much. My pleasure. All the very best, folks.